Okay, let's go. Chapter 8. So chapter 8 is really talking about inventory. And what I'm going to do is I'm going to create the context so you can see what's going on here. With this, let me just here we are. I've said this before. Accounts need to be four things: relevant, reliable, understandable, comparable. Because we have external stakeholders using these accounts, so they trust the accounts, which means that when you say something, it's like someone saying, I have £50,000. Well, we at least think he'll have £50,000 tomorrow, or this money belongs to him, it will be in the bank, or something along those lines. You know, when you talk now, there is an assumption about you also having that in the future, in some capacity, because that's why you're telling us. You're almost telling us to trust you. You know, even though you're speaking about the now. Because if we thought you wouldn't have it by tomorrow, well, we would think differently. Which is why it's all about principle, isn't it? So, for example, when I say that, when we look at a balance sheet and we see under current assets, we see inventory, trade receivables. I'm only going to speak about these two for now. If you said you had bought, and I'll talk about this in a second, so we get some. I'm going to deal with the terms as I'm speaking as well. Inventory, 10,000. If you bought this say at the 31st of December, you had closing inventory of £10,000, and you had bought this inventory. Well, you had made purchases. You remember from the last video, you had made purchases during the year of say 15,000, and you had only sold 5,000 of those goods, and you have 10,000 left. You bought this inventory, say a month ago. This is referred to as your cost. So just let's get the terms right. This is cost. So the argument must be, right, because when you buy something, the hope is that you'll sell it for more. The argument is that I have this 10,000 right now, and the assumption is that it will sell for more. Now, here's the thing. If for some strange reason, which there are many, that this inventory will not sell for more. So for example, change in fashion, obsolescence of any type, damage of any type, just a bad reputation, absolutely any reason why this inventory will not sell for more, which is the premise of trade, than what you have bought it for, then we cannot continue to tell people that our assets are worth 10,000 because they just aren't. So what we then have to do is ask, well, what is it worth? And that question is what we call our net realizable value. We ask, well, what is it worth now if it's no longer worth what we paid for it? Well, someone will say to you, well, actually, you can actually sell it for 5,000, or that's a bit harsh. You can sell it for 8,000. Well, if someone says it's now worth 8,000, well, we should no longer recognize it at 10,000. We should bring it down and recognize it at what it's worth. And that process of bringing this down is what we're really dealing with. It means you've lost value. It's lost value. And if it's lost value, we need to recognize that loss in value as an expense, right? It's lost value. So let me just complicate this slightly. So for example, typically if your goods have been damaged, and then you had to fix it, and it's now worth, so for example, classic, you had a leak and these inventory had been damaged, and someone said, don't worry, we can fix it. Actually, we can fix it, and when we fix it, you will be able to sell it for 12,000, but it'll cost us 3,000 to fix it. So if it'll cost you 3,000 to fix these damaged goods, and you can now sell them for 12, well, it means their net realizable value, what the net realizable value is 9. So it means it's now worth 9. So it means we need to bring it down from 10 to 9, which means it's lost value of 1. Right? Remember, your closing inventory is an asset. It currently sits here, if you like, at closing inventory, it's an asset of 10,000. So if we're bringing it down by 9, I'm literally putting 1 on this side, and I have loss on inventory of 1,000 as well. It's an expense. You've lost £1,000. So whether you want to take it, say, -1 or whatever, the key point is that it has lost value. So let's talk about the theory of this, or the concept of this. The accounting concept involved here is referred to as prudence. Prudence says to us, the starting point, what you must accept or agree with, is that the accounting concept, because we make these principles up to a certain extent, prudence says that we must always anticipate losses and never anticipate profits. So, going back to my inventory scenario, I see loss here, potential loss, for whatever reason, and the potential loss is the loss of £1,000. So we must anticipate that and therefore deduct that £1,000 from our closing inventory, get rid of it. Now, if on the other hand, for some weird reason, there is some crazy demand for this product, I don't know why. Suddenly people are excited about the product and someone tells you, you see this 10,000 worth of stock? Yes, you paid 10,000, but it's actually now worth 15,000. Well, we say prudence tells us not to anticipate profit. So we don't say, we're going to add another 5 to this because it's now worth 15. No. When we sell it, we can be able to recognize that profit. So until we sell it, we do not anticipate those profits, right? We don't anticipate those profits until we sell it. If we don't sell it, we don't anticipate. So that's what we're saying. We leave it as it is. Leave it alone. So if you like, this concept of prudence, and also now kind of subsumed in some sort of international accounting standard, IAS 2, says what we do with inventory is we always recognize inventory at the lower of cost and net realizable value, the lower. So if you have 10,000 and the net realizable value is actually 15, well, we recognize it at the lower, leave it at 10. If it's 10,000 and it's now 9,000, well, 9,000 is lower, take it down by 1. Right? And that's kind of what you need to practice here. NRV will always be selling price minus the costs if you like to sell it. Right? So that's kind of that's the core. That's the main message of this chapter, which I just put through for you. So yes, that's chapter 8. So please look at this video again. Of course, you're going through the book, and make sure you cover as much of this as possible. Yeah, you're still in the revision mode, so you're still reading the book, but this is just a booster. Okay, great stuff. See you in chapter 9.